The question becomes whether the next adjustment happens through price, structure, or access, and that question doesn't stay academic for long. At this point, the significance of Shanghai's premium isn't directional, it's diagnostic, revealing how the silver market is coping with stress rather than predicting where price prints next. Markets under strain don't fail by announcing shortages, they fail by fragmenting, where the same asset carries different meanings depending on where and how it's accessed. And silver above $100 with persistent regional premiums fits that early-stage profile. What remains unresolved is whether this divergence resolves through increased physical flow, benchmark adjustment, or continued workarounds that mask deeper imbalance, because each path carries different implications for liquidity and trust. If premiums narrow without price retreat, it suggests accommodation. If they persist or widen, it suggests prioritization. And if benchmarks chase them higher, it suggests acknowledgement, none of which are neutral outcomes. And as long as Shanghai keeps paying more to secure silver while global prices struggle to explain why, the market is left facing a quiet but uncomfortable possibility that price isn't leading this cycle at all. For decades, silver has been priced as though it were infinitely mobilizable, a metal that could always be summoned through contracts, swaps, and warehouse claims, but Shanghai's premium challenges that belief without confrontation. Silver above $100 isn't by itself proof of a broken market, yet when that price coexists with persistent willingness to pay more for delivery elsewhere, it suggests that the system is absorbing pressure through segmentation rather than resolution. What's unfolding doesn't resemble panic or euphoria, it resembles quiet reprioritization, where access matters more than exposure and timing matters more than theoretical value. If that behavior persists, the market won't need a dramatic catalyst to adjust because the adjustment is already happening incrementally through terms, availability, and trust in benchmarks. And if history offers any guidance, it's that when physical premiums speak this clearly for this long, they're not commenting on price levels, they're commenting on structure, and structure is what ultimately decides how markets reprice. It signals that higher prices aren't dampening demand in the way textbooks would predict, hinting at priorities that aren't price-sensitive. That's when the question shifts from whether silver is overextended to whether the market is misreading who the marginal buyer actually is. Because if the marginal buyer needs metal rather than exposure, price behaves differently. At the margin, Shanghai's behavior suggests that silver isn't being pulled by momentum traders, but by entities with delivery obligations. And those obligations don't disappear when prices rise, they harden. In past cycles, premiums narrowed as higher prices rationed demand, yet this time the premium coexists with elevated pricing, implying that demand isn't discretionary and that substitution, at least in the short term, isn't happening fast enough. What complicates interpretation is that none of this requires a declared shortage, because modern markets adapt before they break, using premiums, delays, and selective fulfillment to absorb pressure without triggering alarms. Reports indicate that inventories can still be found, but the conditions attached to accessing them have changed. And when conditions tighten while prices climb, it often reflects an effort to preserve optionality rather than maximize turnover. That preservation of optionality is subtle but telling because it suggests participants are preparing for scenarios where holding metal is more valuable than monetizing it, a posture that rarely aligns with confidence in abundant supply. Historically, when physical markets start behaving defensively, it's not because participants expect immediate disruption, but because they see asymmetry building, where the downside of not having metal outweighs the cost of paying up for it. Shanghai's premium fits that pattern, not as a protest against Western pricing, but as an insurance premium paid quietly by buyers who can't afford timing risk, even if headline prices already look stretched. What's notable is how little noise accompanies this shift. No official warnings, no dramatic volume spikes, just a steady willingness to transact above reference prices, which often signals internal constraints rather than speculative fervor. In that environment, price becomes less of a clearing mechanism and more of a reference point, while availability is negotiated deal by deal, and once that transition begins, it's difficult to reverse without structural relief. The longer silver holds above $100, while Shanghai continues to validate higher effective prices, the more the market has to confront whether benchmarks still reflect reality or merely the last place where trading remains frictionless. At this stage, the pressure doesn't express itself through headlines, it shows up in behavior, particularly among hedgers and intermediaries who rely on smooth turnover to manage risk, because premiums complicate hedges in ways models don't easily accommodate. When physical silver clears at prices that futures don't fully recognize, hedging becomes imperfect, and imperfect hedges force firms to choose between margin risk and inventory risk, a trade-off that rarely stays invisible for long. Refiners and fabricators sit in the middle of this tension, caught between input costs that reflect physical reality and output contracts anchored to benchmarks, and when that spread widens, someone absorbs it quietly until they can't. Market behavior implies that some participants are already adjusting by shortening commitments, delaying offers, or renegotiating terms, actions that don't move charts but subtly reduce available float, tightening conditions without formal restriction. Once those micro adjustments accumulate, the system doesn't snap, it stiffens, and that stiffness is the precursor to repricing that looks sudden only because the groundwork was laid out of view. Behind closed doors, risk managers tend to watch premiums more closely than prices because premiums, silver has been treated as a secondary metal, priced in the shadow of gold and managed through paper systems designed for stability rather than stress. But when prices push above the 3-digit mark in live trade while Asia pays more to secure metal, the framework that kept silver quiet starts to show strain, and that strain is rarely accidental. At first glance, a premium in Shanghai looks like a regional quirk, a logistics issue, or a timing mismatch between exchanges. Yet, when the gap widens while Western prices hesitate, it stops behaving like noise and starts acting like a signal that something upstream is changing. Historically, Shanghai doesn't lead price discovery by shouting, it does it by paying, and when domestic buyers consistently accept higher prices rather than wait for convergence, it implies urgency that futures curves and official commentary don't fully capture. Quietly, the difference between where silver trades and where silver is wanted begins to matter more than the headline price because premiums don't reflect optimism, they reflect availability. And availability is where controlled markets tend to fracture first. At the institutional level, traders understand that sustained premiums aren't a vote of confidence, they're a workaround, a way to bypass constraints without challenging the system directly, which raises an uncomfortable question about why that workaround is suddenly necessary. And once silver trades above psychological thresholds while Shanghai keeps paying extra to pull metal inward, the focus shifts from price targets to flow dynamics, because the real story may not be how high silver is, but who's no longer willing to sell it at prevailing terms. For years, Shanghai's silver market has functioned less as a price setter and more as a stress gauge, and when that gauge moves independently of Western exchanges, it usually reflay. CTS pressures that haven't yet surfaced in official data. Under normal conditions, arbitrage closes gaps quickly, metal moves, paperwork clears, and premiums fade. But when those gaps persist despite clear financial incentives, it suggests that moving silver isn't as simple as moving contracts. And that distinction changes how the market should be read. Behind the screens, Chinese buyers don't chase paper exposure to hedge portfolios, they secure metal to satisfy industrial demand, inventory policy, and strategic stockpiling, and when they accept higher prices without hesitation, it implies timelines that can't wait for futures convergence. What's subtle is that these premiums aren't explosive or panicked, they're steady, almost procedural, which is often how supply tension appears before it's acknowledged, raising questions about what constraints are being managed quietly rather than discussed openly. As silver trades above $100 while Shanghai continues to signal willingness to pay more, the implication isn't scarcity in headlines but friction in fulfillment. And once fulfillment becomes the bottleneck, price